I just made every mistake in the book. I never learned the fundamentals of real estate investing. It was very humbling when 2008 came.
All right, folks, welcome back. We got an interesting conversation today. If you're in the world of real estate, you've considered investing and you don't want the toilets, tenants, and termites, and you don't want to become a landlord, but you do want cash flow, appreciation, and tax benefits, then you're going to want to pay attention today. If real estate investing seems to you like something that's way off in the distance, or maybe it's extremely expensive and you wondered, how can I get involved with other people in the idea, or maybe even a tribe building around the idea of investing? And maybe could I do it for 5 or 10 grand, not 50 or 100 grand? How do I get started? If I've been thinking about it, then this is the episode you're going to want to pay attention to. I brought on a guest here today, Brian, who's going to go over this with me. He built tribes around fractional reserve real estate investing. And so we're going to talk about what that means. We're going to get into the details. We'll have some fun today. Who knows what conversations we will spawn into as we have this conversation today. So guys, I welcome you to the call once again. Brian, thanks for joining me, sir. I appreciate it. And let's dig in here on some of this. Did I get your intro good enough for you? Is that it? Should we just end the call now?
It was beautiful. It was a work of art.
Got it? All right, there we go. Not bad for off the cuff, right? Tell me about, this, the world of real estate. What does it mean to you, and where have you been at, and where are you going?
Yeah. So, the 30-second overview of how I got into real estate in the first place, I just fell in by accident out of college. I worked for a hard money lender right out of college who happened to be a friend of my stepdad's. And, I didn't know anything about finance or real estate or hard money lending or any of that stuff. But I ended up enjoying it. As a hard money lender, I was working exclusively with investors. So this was back in the early to mid aughts. Everybody is making money hand over fist in real estate, working with people who are buying fixer-uppers, renovating them, and then either flipping them or keeping them as a rental property, refinancing. And, I'm watching all these guys make money. I'm like, I could do that too. Like, I'm smarter than those guys. Like, why am I not doing that? So I went out and I bought a ton of properties. I put every penny that I had to spare in buying rental properties. And most of the cases I was doing the BRRRR strategy. So I was buying fixer-uppers, renovating them, and then refinancing to keep as rentals and, pulling my down payment back out of them. And I just made every mistake in the book. I never learned the fundamentals of real estate investing. I just, stupidly assumed that I knew everything I needed to know by, somehow by lending money to people who were doing that. So yeah, it was very humbling when 2008 came. And not only did all of my investments completely collapse, but so did my day job, because my day job was working with real estate investors. All of a sudden, nobody's investing in real estate anymore. And it's certainly not flipping houses or anything like that. So it was back to square one for me. But I went on and I worked for an e-commerce company that specialized in working with mom and pop real estate investors. And the only reason I got that job is because I myself did own properties. So, it is true what they say that, one door closes, a window opens. That's just how the universe works. So
Pivot.
I spent a long time working for that company. In 2016, a coworker of mine and I split off to start our own company. And I was living abroad at the time. I'm still actually living abroad. And we can talk about that if your listeners are interested.
Talk about all of it.
To wrap that up, we've been in business for going on 9 years now. And, it's so true that what you think your business is not necessarily what the market thinks your business should be. And,
I call that the entrepreneurial journey.
Exactly. So our business has evolved quite a bit over the years. Our main focus today is completely different from what we were doing when we first started. The only similarity is that we're still servicing real estate investors. When we started the business, we thought that our business was going to be a one-stop shop landlord software for mom and pop landlords, because at the time there wasn't really a good one out there, and they're still kind of limited. But neither my partner nor I are technical or founders, and we did end up launching a software platform, but our business has really become more about education and co-investing. The focus has shifted towards passive real estate investments rather than active real estate investments. So I gave you a lot to chew on there, but that's the high level overview of how I got involved in real estate.
Yeah, let's unpack the you person a little bit, because you said some really cool things in there I want to get into. And that's, for the mindset of somebody listening to this in business, real estate, finance, investing, e-commerce, whatever it is, there is something you said that's critical. You pivoted. I use the term pivot, but you kind of said, you had turn. Tell me why you didn't keep going? What was your tenacity? What was your drive? What was your motivation to do something? Why didn't you just give up and go do something else?
Well, there's a couple answers to that question. So for one thing, like I mentioned, I was living overseas and I wanted to build my own online business that I could work from anywhere in the world. And my wife and I have lived in several countries since then. We've moved around the world quite a bit. So I wanted something that was completely my own, where I could work anywhere in the world. I did not want to just go get another job. I've always had an independent streak. Of course, when you go into business, I feel like no one really tells you that being an entrepreneur is way harder than being an employee, and that it really you should only become an entrepreneur if that's the only option that you see on the table. Like I have to do this. Like, this is my
I
mission.
have
This
to
is my
break
calling. Like,
free. I have to
like
get out of this. I have to stop this. Is there some pain involved in something greater than keeping your current status quo, right?
yeah, and because it's so much harder to be in business for yourself than it is to work for someone else. So, if you can see a path forward to happiness being an employee, then go do that because that's easier. But yeah, I felt called to be an entrepreneur. I really wanted to have an online business where I could control my time, control my location, and that is what I had built for myself. It took a lot longer than I thought it would take, but yeah, one of the things that happened to us very early on, we hired a software developer and they ran off with our seed capital, basically. So
Oh,
we no longer
okay.
had enough money to build out the software platform that we wanted to create when we first started the company. So we said, well, we still want to do this, but we don't have enough money to do what we have initially set out to do. So
Okay.
we said, all right, let's start with a focus on education, and then we will build out the software platform, with other developers and kind of on our own, and we'll piece it together over time, which we eventually did. But in the course of focusing more on education and teaching people how to invest in real estate, how to become a landlord, how to build passive income from real estate, we discovered that that was actually a huge area of passion for us and more of an area of passion than software, which, like I
Yeah.
said, neither my partner nor I are technical founders. So that that took on a life of its own, where we started launching online courses to help people get started in rental investing and real estate investing more generally, and launched a series of courses, reaching financial independence in real estate. And one of the questions that kept coming up again and again from our course students and from our audience was, hey, I'm not quite ready to go out and buy a property by myself yet, but I have a little bit of money to invest. Like, can I just invest with you guys on a project that you're doing? And, this as a so we kept saying no to those people. But that question kind of it forced me to confront the fact that I was a little bit out of alignment, where I was teaching real estate investing, but I wasn't actually investing in rental properties anymore. I still had some rental properties back in Baltimore, but I was living in Abu Dhabi at this point. My
Cool.
wife took a job. Yeah, yeah. So we were living across the world in Abu Dhabi, and I didn't feel great about the fact that, I was teaching rental investing, but wasn't actually investing anymore in rental properties. And then at a certain point, I actually ended up selling off all those properties and getting rid of them. And then I really felt out of alignment with it. But it was around that time that I discovered passive real estate investing, first through real estate crowdfunding platforms, and then through real estate syndications, and later through JV partnerships and other private partnerships and real estate equity funds and debt funds and private notes. So I loved that. I loved that I could do it from anywhere in the world. And I went to my partner at a certain point and said, hey, people keep asking us if they can invest with us. Maybe we try to find a way to say yes to that. How could we make that happen for our course students? So we started by partnering with an investor in Michigan, and we did a couple deals with him, single family home deals, and we allowed just our course students to join us on those deals. And those deals did fine financially, but we realized that they were way too much work.
Yeah.
So then we went back to the drawing board, and I was like, well, what if we went in on some passive real estate investments together?
Okay.
What if we tried a real estate syndication together, for example? So that
Okay.
instead of, so that, yeah, one of the challenges with syndications is that they have a high minimum investment, much like buying a property by yourself.
They're
Minimum
typically going
investment,
after larger multi-tenant size, deals that are 5, 10, 20 million in size, right?
Right, exactly. So, limited partners who are passive investors in those deals, they must typically come up with at least $50,000 or $100,000 depending on the deal. It's a relatively high minimum investment. And it's comparable to what you would need for a rental property, between the down payment, closing costs, initial repairs, cash reserves, that sort of thing. But, that's a lot of money for a middle class person to park in a single investment, right? Whether
Mhm.
that's a rental property, whether that's a real estate syndication. So we said, well, what if we went in on one of these real estate syndications with some of our students? What if we all pooled our money together and went in on one of these, as a single LLC, a single limited partner in this deal, so that each of us could invest, 5 grand or so instead of 50 grand or 100 grand. And my partner was like, let's try it. So we did. We did a pilot deal there. It went well. We got really positive feedback from our course students. So we did another one and then another one. And then we said, well, do we have to restrict this to just our course students? Could we open this up to the general public? So we sat down with an attorney and he said, yes, you can. It's the classic investment club model that people have been
Yep.
doing for decades.
Yeah.
So we did. We opened an actual investment club. We call it our co-investing club by Spark Rental. And this is what we do month in and month out. We get together as a club, we vet different investments, we go in on them together. So each member can invest relatively small amounts in these deals.
Okay.
And it keeps the deal flow going. It lets people diversify and spread small amounts across a lot of different deals. And it's fun. It's a lot of fun.
Yeah.
And I feel completely in alignment with it because this is how I personally invest in real estate every
Okay.
single month. I'm in
Okay.
the trenches alongside of our members, investing my own personal money as just one more member of the investment club. So
And what kind of
it's
assets are you going after? Like, what are you acquiring? Multi-tenant, four, 200 units? Like, what are you typically going after?
Yeah, so that's a wonderful question. One of our core values is diversification. So we are agnostic on property type, even on investment type, as long as it is a passive real estate investment. So, and it's worth pausing for a moment to clarify, we're not operators ourselves, nor are we a fund of funds. We are strictly a flat fee investment club. So our members pay us a flat monthly fee or annual fee to be members in our club, but we don't get a cut of any of the money that is invested every month by our members. We're not selling securities. So, we're not out there like raising money ourselves for
Okay.
our own deals. We're not going out there and like buying apartment complexes ourselves. We're simply organizing the investment club. So that's an important distinction because a lot of people, when they first hear about us, they're like, "Oh, so you guys are a fund of funds, or you guys are an operator, or something." No, we are not. So, and that frees us up to invest with people who do specialize in certain types of investments. So we've invested in a lot of multifamily syndication deals. We've invested in industrial deals, retail properties. We've done private partnerships with house flippers and spec home developers. We have lent out private notes. We've invested in equity funds and debt funds. We've done it all, really. So, and that's part of the beauty of what we're doing is every month it's a completely different investment in a different geographical location with a different operator. So it spreads our risk out,
Yeah.
across all of those different variables. And perhaps even more importantly than any of those variables is the time diversification, the time commitment for these investments, because that can be a deterrent for a lot of people that are first getting into passive real estate investments.
Yeah.
Your typical syndication deal, for example, there's a time commitment, usually in the 5 to 7 year range. So we also look for some shorter term deals. We've done investments that are as short as 9 months. We do others, 1 year, year and a half. Some of them are more medium term, like 3 years,
Okay.
along with some of the more traditional 5 to 7 year investments as
Well,
well.
if it's a bit
So
of diversification in the type of investor profile or something someone's needing or wanting to do in terms of where to put their money and how long to keep it in there and make it active, right?
And it's nice to be able to ladder your investments so that they're coming back to you at, kind of punctuated intervals. So,
Yeah.
you're not locking up all of your money for the next 5 years or the next 7 years, saying, well, some of it's going to come back in a year from now. And then, this other one's going to come back in 2 years from now. And this one will come back in 3 years from now. And the other one will come back in 4 years from now. And so on. So that, none of us know what the future holds. But, keeping that flexibility of having investments that will be coming back to you on different timelines, it helps you prepare for an uncertain future.
Are you leveraging banks at all in any of this, or just straight up crowdfunding aspect?
So in the typical syndication deal that we invest in, The operator is borrowing a loan. So, for anyone who's not familiar with how syndication deals are structured, normally what the operator will do is they'll say, well, there's this $10 million property that I want to buy, whether it's an apartment complex or, whatever it is. I'm going to go out and I'm going to borrow 7 million of that from a bank as a loan. And then I'm going to put another 1 million of my own cash involved, but that still leaves me $2 million short. So I'm going to go out and I'm going to raise that final $2 million from passive investors like us. So we become basically silent partners on these deals, these larger syndication projects. The technical term is limited partner, but we are equity owners. We're entitled to cash flow, and we get appreciation, and we get the tax benefits. We get a K-1 with great tax benefits every year. So that's
you're the
kind of
fund that basically fills in the gap for those who are already investing in some of these larger deals, which means you may take a $1 or $3 or $5 million position in the deal as a minority limited partner who takes cash flow out while you're not operating or funding the majority of the deal. You are getting the benefits of the cash flow.
Yeah. So we become basically fractional owners of these larger properties, and the operator is going out and getting a loan in most cases to fund some of it. And then they raise some additional capital from us. We step in as like fractional partners, fractional owners in these larger property deals.
Now, you work with a series of individual or investor groups already that you kind of have floating around looking for these deals, and you kind of step in as the fractional money, or do you go out and find new ones? Or
so we're our own investment club. So most of our members are just working professionals who they want to add real estate to their portfolio, but they don't necessarily want to become a landlord, and they don't necessarily want to park 50 grand or 100 grand at a time in any one investment. And then, we will then meet as a club every month. We'll look at different passive real estate investments, say, okay, this is the one we're looking at this month. Anyone who wants to participate in it can do so. Like, here's the operator. We'll bring in the operator to come and answer questions directly from all of us as a club. So we'll all grill them and try to poke holes in the deal from 50 different angles. But it really helps to have, 50 sets of eyeballs on these deals and, have all of our members' different experiences coming together to vet these deals as a group. So, a quick example of that, we have a member of our club who's very active, who is an insurance adjuster. So she's always grilling operators about like, why are you only projecting this much for insurance premium growth over the next year? And, and then we have often we'll have a member who lives locally, wherever that particular investment happens to be. So they'll be able to say, I drive past this property every day on the way to work. And, I can tell you firsthand that, there is a lot of demand for housing in this area, but not enough supply, or vice versa, right? And say, maybe we shouldn't invest in this deal. So that's really helpful, just to be able to vet these investments as a group of people, instead of you kind of on your own by yourself, trying to figure it all out on your own.
Yeah. A lot of people think about, putting money in and parking it somewhere. What's my, APY? How do I get, returns on that investment if I go and hold it? Or how do I get back, $5,000 a month in cash flow? Let's say I've got, 10,000 sitting and I put that in. What's that possibly going to return me every month? Do I get a cash out every month? Do I have to wait every quarter? Do I have to wait till the deal is done to cash flow out? Let's say, create a hypothetical for me real quick as an average investor who might be listening to this and saying, hey, I'd like to make an extra 3, 5, 10,000 a month. How would I do that working in your tribe?
Yeah. So we, as a general rule, on our equity investments, we aim for mid-teens returns or higher as total returns on the deal. Now, in a lot of those deals, some of that will come from distributions, cash flow while we own the property. And then some of it will come as profits when the deal sells in, 3, 4, 5, 6 years. But I mean, what we have seen is that most of these deals will cash flow in the 4 to 9% yield range as the income portion of the returns. And then the rest of the returns will come on the back end in the form of profits when the property sells. So that's for our equity investments. We aim for mid-teens or higher. For debt investments, we accept returns that are a little lower if we think that it's a very low risk investment. And those are all income. I mean, it's all just interest income. So, 10 to 12%, is really what we're willing to do for debt investments, where we're just getting monthly interest payments on it. But anything less than those returns, it doesn't really make sense for someone to pay a membership fee to be able to access the returns.
Yeah.
And part of our mission is really finding asymmetric returns, finding investments that offer asymmetric returns. So relatively high returns, or high potential returns with relatively low risk. A lot of investors get caught up with sort of two-dimensional thinking about investments, and they just look at the axes of risk versus return. There's all these other components, there's all these other factors that go into investment decisions, that people that can skew that. It's not, risk is not the only factor that determines returns, and that is what we're going for here. People, when they first hear, oh, you're aiming for 15%, 20% returns, but you're saying that, it's low to moderate risk, that doesn't make any sense. It sounds scammy. How could that be? And that's because there are other factors at play, like liquidity. If you can't access your money for 5 years, 7 years, that is a factor at play. That is why private equity has historically returned higher returns than the stock market, and certainly than bonds, because it doesn't have liquidity. That is part of the downside, or the sacrifice, if you will, that you're making. So you can find low risk investments that pay 15%, 20% returns, and maybe you don't get your money back for 5 years or 10 years even,
you gotta sit on it for a while, which for some people feels extremely risky in today's marketplace, or just, unknowns and factors and questions.
Right. So liquidity is an element there.
Yep.
The time commitment is a factor there. The shorter term investments that we make, those, some people see those as lower risk, or, but, maybe they don't have the returns, right? So there's all these factors at play. Personal values is another one of those, factors involved in investment decisions. I was just looking at these numbers the other day, that if you look at the returns on oil and gas drilling, they're very high historically, and pretty consistent. They're consistently in the high teens or better. But a lot of people have personal values that conflict with that and don't want to invest in oil and gas drilling, right? I'm not saying that we don't invest in oil and gas drilling. I'm just offering that as an example of how there are all these other dimensions to investment decisions beside risk and return. So It is absolutely possible to go out and find asymmetric returns. And that's what we're trying to do in our investment club. We're trying to find high returns with relatively low risk. But there are other variables that you have to consider, like liquidity, like time commitment, et cetera.
And hopefully people are paying good attention to that, because that's a smart way to think about this in terms of your investment strategy and what you're into, and invest in what you know, or invest in the knowing, is what we always say. If it's something you want to know about, definitely check it out, guys. If you are, looking for those high returns in real estate, if you're looking for the tax benefits, if you understand the model that was explained today, this might be something you want to check out in the notes at sparkrental.com. Go see what Brian's doing, have a conversation, see if it's a good fit for you. The goal here with these podcasts is always to introduce people to ideas, and people of, your nature. You're doing it yourself. You're in your own business. You've built this. You have struggles. You pivoted. You figured out where your sweet spot is, and you're doing it. And that's one of the stories we love to tell about this, which I appreciate you telling me today.
Yeah, it's been a lot of fun. I appreciate you having me on to chat about this.
No, I appreciate you, brother. And is there something I didn't ask, or question that we didn't bring up on the, you wanted to cover today that we didn't get to yet?
No, I think the main thing that I want people to consider, if they've never heard of passive real estate investments, or, they only know at a glance, what maybe a syndication is, or that there's so much out there, so many ways to invest in real estate that don't require you to, roll your sleeves up and flip houses or become a landlord. You have all of these different ways to invest, from real estate equity funds and debt funds to private notes and JV partnerships and real estate syndications. And, the list goes on, and crowdfunding and REITs, of course, as well. There are plenty of ways to passively invest in real estate where you're just writing a check and not actually having to do any of the labor. So look into them. Find ones that are a good fit for you if you want to add real estate to your portfolio, because you have plenty of options on the table.
Awesome. Well said. Thank you, sir. Appreciate you coming on.
Thanks for having me. It was a lot of fun.
All right, guys. As always, like, comment, and share. Help us beat big tech. Even if it's snide comments, you don't care. Get us on YouTube if you want to watch the video, Apple Podcasts, Spotify, everywhere else. Make sure you check out the show notes and things that are going on with Brian. If it's, crowdfunding real estate investing, and you want to get with a tribe and understand more about it, I would encourage you to check it out. Have a great time, guys. We'll see you on the next episode.